Ipsas. So diploma in Ipsas is near at the end, isn't it? So we are approaching the exam. So in most cases, we must concentrate on key topics where we can grasp some of the knowledges, right? Today we are going to discuss on Ipsas 17 in particular. So Ipsas 17 and Ipsas 16 are the issues which goes together. And if you can notice, you must be very much aware as to which classes of our buildings can be classified in this cloud. So I'm expecting you to provide me with a supporting discussion because I want you to discuss these key issues so that you understand. Actually, the term PPE as it works, and I will do it practically. The term PPE, it means what? Property, plant, and what? Equipment, isn't it? So today's topic is property, plant, and what? Equipment. So property, comma, plant, and what? Equipment. Now, this standard is an asset-is standard. When I say asset, what does it mean? Asset is defined as what? Number one, it is a present resource. To see, an asset is present what? Resource. A resource which is present in a public sector. Number two, an asset must be controlled by an entity. When I say control, I mean ability of public sector to restrict other public sector to use that asset. That's the term control. So the control, it would mean a public sector receive asset from another public sector in a form of transfer, and there is a transfer form signed by the Paymaster General. So a control is deemed to exist if a public sector can restrict other public sector to benefit from service or contractual cash flows. For example, if a motor vehicle is transferred from VETA to Talula in a normal form of transfer, and there is no transfer form which has been approved by the Paymaster General, Talula cannot have a control of such a motor vehicle because it can't restrict other person to use. The VETA can request such a motor vehicle to be back. So when I say a control is a possibility of a public sector to restrict other public sector to benefit from such a motor vehicle. Do you see how it works? If you cannot restrict, then you don't have a control. A control does not mean ownership. No. And that's why motor vehicle in the public sector, their registration card are somewhere in central government. But they have control because of transfer form and other directives from the government. Are we together? So this is how a control is. So in order to audit a PP schedule, and a supreme auditor will start from a key observation. How did you buy such motor vehicle? So we have procurement process. We have authority from the board and others. Or if you receive a building from another public sector in a form of transfer, then you must indicate the transfer form, showing that a Paymaster General has approved a transfer of the said building from one public sector to another public sector. This is how control exists in public sector at large. Do you understand from there? So this is how control is. Number 3, for the case of public sector, we are expecting the asset to generate future benefit or service potential. So, future benefit or what? Service potential. So actually, these are the key elements when defining an asset. For example, if you own a motor vehicle which has been grounded for a long time because of either accidents or any administrative arrangement, you cannot say that this is an asset because its future benefit is not expected when it is grounded. An auditor will always request and issue an audit query to explain why is this asset being grounded without taking procedure of impairment or administrative procedure to dispose them. So this is what an asset is, in particular as an asset. So in order now to move from here, in the public sector also, for the term of asset, we have either service potential or future benefits. Somebody can question you and answer, a very little question, that explain the difference between FRS and Ipsas. One of the difference is, in Ipsas, an asset contains service potential and future benefit. But in FRS, an asset contains only future benefits. That is a strong difference on how to get in. Now let's see for another key issues. Now an asset can be classified into several key issues. As you see from conceptual framework, chapter number 5, it explains about elements. Do you remember? So in elements, we have asset, you have liability, we have revenue, you have expenses, isn't it? It is from there, when you go to chapter number 6, 7, and 8, we have some people key issues. Key issues relating to what? To elements. Number 1, you must look for definition. So define asset, define liability, define revenue. Number 2, you must look for recognition. Do you see? Explain how do you recognize asset in financial statements. Explain how do you recognize revenue in financial statements. Recognition is a process of incorporating an element that meets definition of elements into financial statements. And that's why when you want to prepare financial statements, sometimes you can include some elements into financial statements, and sometimes we disclose those elements in the notes. For example, provisions for liability relating to pending court cases. These are liability which are recognized as liability in financial statements. By contingency liability are not liability because they fail recognition criteria. And therefore, we don't incorporate in financial statements, but we put them in the notes so that a user have to understand the future litigation. So recognition is a process of incorporating an item that meets the definition of item into financial statements. Number 3, measurement. How did you arise in getting a monetary value of an asset? Now, measurement, how to get the value? And this measurement is deemed to be assessed initially when you receive an asset and on subsequent when an asset is performed within a public sector. Number 4 is disclosure. Disclosure, what are the items to be shown? To show it explicitly. Disclosure And number 5, presentation. Do you get the point? Now, these are the key issues. Now, if you see from Ipsas number 1, once somebody say, define what is an asset. An asset has been classified into 2 components. So you could see asset now can be classified into 2 components depending on the presentation. The first component is current assets, which includes inventory. It includes cash. It includes receivable. It includes prepayments. Do you see? Do you see? Prepayments. Now these are what we call current assets. Any other. We call them current assets because the way it is consumed within a public sector is contractual with accounting cycle. It is deemed to exist within a period of 12 months. Otherwise, it is a non-current asset. So a non-current asset has no definition. Non-current asset. Ipsas number 1 say that non-current asset are all assets which are not current asset. So the examples from here includes what? Number 1, land. Number 2, building. Number 3, motor vehicle. Do you see? Number 4, infrastructure. And that's why if you construct a road, I repeat, if you construct a road whose useful life is 1 year, that's not a non-current asset. Talula has such kind of road. They construct those roads which are seasonal. The cost of construction in those lots cannot be presented as an asset. They are expensed. Tanapa, Tawili, and other entity of such we would like to construct those seasonal lots in those areas of the operations, which does not exceed 1 accounting period. Those lots cannot be presented as a non-current asset. Simply, they don't meet this definition of non-current asset. Am I together? If you secure a license to operate a business along with Nyerere Square, do you see? And that license has a validity of 1 year. Such license is not an asset because its useful life does not exceed 1 accounting period. I'm a tax consultant. I have a tax consultant's license, which is renewed every after 2 years. Now, is it an current asset or not? Explain. Number 1, it exceeds 1 accounting period, and therefore, this is an intangible asset. In Ipsas 31, it is a non-current asset, but intangible. Do you get an idea? So in this ground, now, once you see a definition of asset, it can also be presented in a current asset and non-current asset. Do you see? Now, you see, presentation is a process of locating an item to its position. You can't present a building as a current asset. That's not. A building is not unless such a building is held for sale in a course of business. For example, National Building Corporation can hold several buildings for sale. Once those buildings are held for sale, then such a building is deemed to be classified as what? Inventories. If you buy such a building in your books and you are using as head office, then the building status will change to become a current asset. Am I clear? Now, what I'm saying today is to explain the details. We want to describe clearly PP schedule and its content. Am I clear? So now in the PP schedule, what we're saying, it explains the non-current asset, tangible. So as you see here, it is very clear now to the matter of fact that even if you go in details, once you talk about the non-current asset, they have been grouped into two. As from this standard, I will explain details and other key issues will follow. So, non-current asset, in particular as non-current asset, are those assets which are not current asset. Now, these assets are classified into two. Number one, tangible. Number two, intangible. Now, once you say tangible, means physically, you can see them. In this intangible, we have many non-current assets here and many standards. For example, we have Ipsas 31, which is software, Epico, Musi, and others. Again, we have Ipsas 39. We have bonds which are traded for the defined benefit plan. Again, we have financial instruments, which are also intangible assets. These financial instruments are classified in Ipsas 28, 30, 41 currently. So financial assets are here. So these are intangible assets which can be classified as non-current asset. For example, if you buy bonds, which is going to exist in the books for 10 years, that is a non-current asset, but intangible. You get the point? Now, here intangible asset, it is generally now classified as PP, although you must take care. So, tangible asset, the following standard prevail. Number one, Ipsas 17. Number two, Ipsas 16. You can proceed. Because if you go to Ipsas 43, there is the right of use asset. Also, it is tangible. If you move to other standards, such as service concessional arrangement, you can see initially you use Ipsas 32. On subsequent, you move to Ipsas 17. So this PPE, this tangible asset, is now where we are going to explain the details from the subject matter today. Now, tangible asset, PPE, will include what? And what are the features? But then, in order to describe a clear understanding, let me first describe something PPE in its definition. The term PPE, in a common names, it means on and what? On and occupy. On and occupy. Meaning, you have a control of an asset and you are using it. You get the point? That is PPE. Ipsas 17. But then we have investment property. You get the point? Investment property. This one here does not mean own and occupy. In this ground, it says commit money and left for investment. You get the point? It means commit money and left for investment. So this is committing money and left. Leave for investment. Leave for investment. That's a good language. Leave for investment. So you have committed money somewhere and you become an owner of that asset, but you leave it for investment. So now what are the difference? Let me go and digest it. For example, if Makwea build a house, Makwea, she's here as a director of finance to Veta, and she owned a house along with Nyerere Square. So she has a title deed on it. She has a control. And she can restrict others to use. So Makwea is owning a house along with Nyerere Square. This house is called Block A. This house contains 40 apartments. 40 apartments. And these apartments have been rented to commercial customers along the Dodoma City. So Makwea is not living there. Makwea is not using such house in her business. So it has been left to other people, let use for their own business, and at the end, they pay rent back to Makwea. So, rented on what? Commercial purpose. It is rented on a commercial purpose. Now, Makwea is expecting to do what? To receive rental. Here, back, there is what? Rental income. This rental income must be supported by the operating lease, which has been tested by legal advisor, indicating how much rent is payable per month and even per year. It is in this ground the tax authority will demand the withholding tax on such rent, because this rent is held on a commercial basis. So in this ground, we have what? Operating lease. Now, this building here, owned by Makwea, in her books, we call them investment property. So Makwea has constructed Block A and leave it for commercial customer to use them for their own business. And she's expecting to receive rental income against the lease agreement under operating lease in Ipsas 43. So operating lease, Ipsas what? 43. How to account for the income. But this building, Block A, is accounted in Ipsas 16 in the balance sheet. So the way you present them in the financial statements, you have to use Ipsas what? 16. Do you see how it works? So in this ground, that's where you now can see the same building can be classified as investment property, and in another condition, the same building can also be classified as what? PPE. Now the ground to be a PPE, then Makwea have to construct a building, Block A, now block B. Block B is now here. Makwea has constructed block B along with Chamwino, and she has introduced a hotel business owned by Makwea himself. So in block B, this is a hotel. And this hotel is owned by Makwea, the owner. So he is using. So he own and occupy. Do you see how it works? This is the owner, occupier. He own and occupy. He does not leave it for investment to other commercial customers. That is how it works here. So, in this ground, block B is PPE in Ipsas 17. Let's see me place it here. So, this hotel limited is owned by Makwea. So, Makwea is expecting to receive profit from hotel. You see? So, profit from where? Hotel. So, Makwea does not expect to receive rent from the block B. No. She owns a hotel and she is using it in her business. Let's be back to Dodoma City. Along with White House, Dodoma City has constructed a building. Isn't it? Now, question number 1. Who is using that building? That is an audit query number 1. Who is using the building? If Dodoma City is using such a building to run a hotel, then it is owner occupier in Ipsas 17. But if Dodoma City has left such a building to other people to rent and use for their business, in exchange, there is an operating lease that indicates rate to income, which is a cash flow in Ipsas 43 lease. Then the block B is an investment property. Do you see how it works? That's how it works. Number 2, if you rent a building, but not on a commercial basis. For example, UDOM has a series of hostels in its premises, and the student pays accommodation so that they live in there. The first question: do any operating lease agreement exist between students and the university? No. Okay. Is such arrangement on market value? Can Diamond Platinum move and live there? No. There is restriction. So all hostel building, I repeat, all hostel buildings within a premises or university are not investment property because they fail to meet criteria of being investment property. In the military, in defense, we have those buildings which are occupied by military officer in order to render security along with the premises. Those premises, nobody can live in there on a commercial basis. Therefore, those premises are not investment property because they are not held for commercial purpose. In most of the schools, secondary school and primary schools, actually, the government makes arrangements so that teachers may occupy some houses closer to the school. Even the hospital, dispensaries, you could see a medical doctor is allocated closer to a certain operating ward so that he or she can render the services. And she's living there and paying a certain portion of rent. Those kind of buildings are not investment property. They are owner-occupier in Ipsas 17. Now, question number one. So, in order to understand, because we are now graduate in Ipsas at this point, we are graduate in Ipsas, and you are going to face challenges. Yeah. Yes. Yeah. Yes. Yes. Now, professional judgment. Let's see it. Yeah. It will happen that perhaps somebody, Kazimoto, another person here, Kazimoto is now having 2 blocks. I will explain. The first block is located in Dar es Salaam. The other block is located in Mwanza. And Kazimoto is serious on his business. The block in Dar es Salaam consists 5 floors. You see, I'll make it very sincerely for you to understand. 1, 2, 3, 4, 5. You see, the one in Mwanza consists 7 floors. Right? 7 floors. So, I'll put it so that you understand clearly. 1, 2, 3, 4, 5, 6, 7. Now, Kazimoto in block A, in Dar es Salaam, say block A, and this is block B. Let's see block A. Kazimoto has rented the upper floor to Tigo. You see, this one has rented to CRDB. You see, and this one has rented to Tanapa. Peoples are living there. And this one, Kazimoto, has rented to Swissport. These are commercial customers. But the ground floor, Kazimoto is using in her hardware business. Now, which class of building is this? Do you see now how it works? That's what I'm saying. You should have some question. And these problems are coming. And when I say PPE, we need to go for practice. Now, in this diagram, we're saying significance of the arrangement indicate that the significant portion of the blocks have been rented to commercial customer. Do you see? Therefore, this is an investment property using professional judgment in Ipsas number 17 and 16 when you read together. You see it? So you can't say that, okay, you use significant professional judgment because Ipsas are basing on judgment, not rule-based. You see it? Now, let's see 7th floor. If Kazimoto is using the first floor, second floor, third floor, fourth floor, and fifth floor, Kazimoto is using these. You see. But he has rented the left of the portion. What is the classes of this building? That is owner-occupier. So this is how you use professional judgment. You get the point? But it may happen also because technical issues are there to arise. It may happen in Kazimoto or somebody, Zeman Limited, on a block along with a square. This block has 4 apartments. The first apartment, the second apartment, and the third apartment. Do you see? Now, this block, Zeman is using the first one and the second one. In the top here, Zeman has rented to CRDB. And the rest one has rented it to Posta Office. Higher. We have 4 floors. Now, which kind of blocks? Is it on occupier or what? So this is the block C. So in this ground, what are your position here? Yes, Elizabeth, ladies first. Makwaya, we need to see support here because actually we need the ladies to participate. Even the numbers here does not explain the way we are fairness. So let's tell me, what is the kind of issue there to stay? In this ground, it is impracticable to place judgment. All right? So either of the two is acceptable. Do you get the point? Either of the two is acceptable. So I think it's okay. Now, it is building, which makes Ipsas 16 to happen. So confusion of whether it is Ipsas 16 or 17, it is building or land. We don't have confusion on motor vehicle, on machines, and the others. Am I clear? So that's why always I would like to make good thing at a start. Let's see the accounting policy themselves. Accounting policy in where? Ipsas 17. Always in a diploma in Ipsa, you don't need to read much and much, but try to go and pick some of the important figures in each standards to see where an examiner can put confusion. Accounting policy arises in every of the standard. For example, in inventory, we have FIFO and what? AVICO. Now, what is in Ipsas 17? It says that initially, when I say initially, understand, initially, PPE will be reported at what? At cost. This is paragraph 43 of Ipsas 17. It says initially, it is reported at what? At cost. Now, it says, number 2, if the asset of PPE has been received in a course of exchange transaction, then use fair value at the date of transfer. If PPE has been received through non-exchange transaction, meaning transfer. For example, you receive a motor vehicle from treasurer. You can't use cost model there. So what he's saying, if this is the case, then a professional accountant and qualified student in diploma in Ipsas have to elect fair value. So initial recognition is either cost or fair value. So use fair value at what? The date of transfer. Use fair value at the date of transfer. And that's why in our financial statements, one of the accounting policy of How did you get the cost of asset? Is fair value, is cost model, and the other measurements which are acceptable. Do you see? Now, when it comes to subsequent measurement, when I say subsequent measurements, what does this mean? Always people will not understand the same subsequent measurements. The subsequent measurements is, for example, Makwaya has bought a phone today, and she has paid 500,000. Okay. Now, what is a value of her phone after 2 years? That is subsequent measurements. How do you get the value of the same phone after 2 years? So a public sector must indicate on which procedure to get subsequent values. So initially is deemed to be year not a date when a PPE is acquired. For example, if you construct a building, you can't use fair value. You are going to use the cost of construction. Building materials, labor cost, direct materials, and all other charges into a building to make a reliable cost. But if it happened, the construction was undertaken sometimes during past period, and all details, documents, and evidence of construction has been misplaced for the reasons better known by other people. Now you want to recognize it. In that ground, we're saying cost model is impractical. So we advise public sector to move to where? Fair value model at a date of transfer. Do you see? So we must have some evidence as to why are we doing this and why this. Now, subsequent is year after year not. So we have year 1, year 2, year 3, and what? Year 5. Now, these are the subsequent measurement, and these are initial. So in Ipsas 17, it has placed 2 policies. It has placed how many policies? 2. Number 1, you can use cost model. Number 2, you can shift to evaluation model. So these are very important. So we have cost model. Number 2, we have what? Evaluation model. So that's where people will now confuse what is a cost model and what is a evaluation model. In actual sense, a public sector in Tanzania has only elected what? Cost model. We never use evaluation model. But in diploma in Ipsas, we have to study what is cost model and what is evaluation. Am I clear? Now, so these are the 2 policies in Ipsas 17. Now, funny enough, people do not understand how a cost model is applied and how a evaluation model is applied. If you pick some question and it confuses students, that's a big problem. Because people are not having an understanding as what is a cost model and what is a evaluation model in its definition. And if I can ask you one question here, that what will happen if a government has changed from cost model to evaluation model? Which accounts will appear in your books of account? Actually, students will not be comfortable to answer such questions. Now, let's go. I will explain today what is cost model and what is evaluation model. But first, I want to go to investment property. Investment property. This one is Ipsas what? 16. What are the policies here? So as I said, it is a problem when I see students here having different views, where in courts and other cases. Now, what is initial recognition of investment property? Number one, initial recognition, as I said, this is the same as initial recognition of Ipsas 17. So it says investment property initially will use what? Cost model. So initial recognition says use what? Cost model. Or you can use fair value through what? When an asset is obtained through non-exchange. Am I clear? Is it okay? Sophia, you understand? Yes. So remember this one. When I say initial recognition, investment property, use cost model, and you can use fair value model when that asset is obtained through where? Transfers. Now, subsequent, what is happening? Subsequently, measurement, you have to elect to use what? Cost model or fair value model. So we have two policies in Ipsas 16. The first policy, fair value model. The second policy, cost model. Now the problem is, and very tricky, and very, very important, what is a difference between revaluation model in Ipsas 17 and the fair value model in Ipsas 16? Do you see? That's very important. If you can't see this question in actual sense, it can be dangerous. Let's put, for example, a building. A building structure constructed by Macquarie. This structure can be used as a head office. So you can use it as head office or use as rental property. For rental. Do you see how it confuses here? Now, if somebody is to tell you, think about this one. When you're using a building as a head office, you are going to Ipsas 17. When you're using that building as a rental, you are moving it where? Ipsas 16. Do you see how it works? Now, the first target, what is initial recognition of this building? In either case, you have to think. Use cost model or fair value model when it is obtained through where? Non-exchange. That is initial recognition. But subsequently, it is a problem. Why? Because if it is a head office, you have two policies here. There are how many policies? Two. The first one, cost model. The second one, Revaluation model. Do you get me? If the same building is used for rental, also there are two policies. First one, cost model. Second one, fair value. You see, this is of a good issues. So we have fair value model. Here, cost model. You see. So we know cost model. Now, what is the revaluation model? Differing from fair value. Once you see this, then you have graduated diploma in Ipsas. If you can't see this actually, people will keep on confusing. What's the difference between a fair value model and the revaluation model? Now, I have to tell you, so that you understand this concept and teach others to go. You become a teacher or an expert in Ipsas. Let us see here on what happened to the revaluation model, and also what happened to fair value model. Number one, what is in the revaluation model? In this ground, revaluation model, you must use an expert registered by the government. Expert registered by what? Government. An expert must be registered with the government. In fair value, not necessarily an expert being registered by the government, except when I say fair value, you are picking figure from a place which is reliable. For example, the price of a cow in Dodoma reliably can be measured from where? Where? Anywhere in the market in Dodoma, where cows are sold. Very reliable. So you pick it from there. The price of share of various companies, fairly, they are picked from the Dar es Salaam Stock Exchange. Do you see? You should have a place to pick figures fairly acceptable. If you want to see the price of certain timber or trees in Njombe, there is a fair price there in Njombe, which is differing from Moshi and other places. Always fair value does change depending to market forces. If you want to buy a piece of plot at Kisasa, its price fairly may differ with that somewhere Nala because of fair transaction and the transaction cost and other cases. So this is how it works. So in a fair, we have market, quoted market. Quoted market price. We don't need a registered valuer to get values using fair value model. But in revaluation model, you must have an expert who is registered and approved by the government. Number two, revaluation model is conducted regularly or after 3 years or 5 years. Revaluation model is conducted after 3 years or 5 years. So revaluation model has a certain trend of years to be conducted. Do you understand me? But fair value does not have a certain period to conduct it. So it depends on quoted market. Do you see it? So fair value has not been restricted as to when to be conducted. But revaluation model, you must do it either after every 3 years or after every 5 years. No duration here. For example, CCM as a public sector in Tanzania has elected revaluation model. So after 5 years, there is an allocation of 8 billion to perform revaluation of asset. Since the document from Bashir, I think you can now see how it is very costly. I was advising them to depart from revaluation model to where? Cost model. Because it's very expensive. So it's very expensive having revaluation model because you need an expert from it. Number 3. So if somebody says, please explain the difference between revaluation model and the fair value model, you just say, revaluation model is in Ipsas 17. And the fair value model is where? Is in Ipsas 16. And that's why people keep on confusing. So you must be aware which standard are you dealing with and which item. You see, you can't use fair value model to measure motor vehicle because the motor vehicle is not an investment property. Do you see how it works? You must be very critical on these issues. We can't use fair value model to measure the motor vehicle or the furniture and the fixtures. Because fair value model is in Ipsas 16 applicable to buildings, plots of lands, and the same, but not laptop, computer, chairs, and others using fair value model. Are you serious? You must take a precaution from there. Number 4, in the revaluation model, in what? Revaluation model, there is revaluation surplus account. That is very important. There is what? There is revaluation surplus account. This account is a reserve. Altogether, this account is a reserve which form a component of net asset in Ipsas number 1. You see. And again, from revaluation is transferred in the revaluation surplus. You get the point? I repeat, here there is no number gapi, number 4. There is no revaluation surplus. So, no revaluation surplus in the fair value model. No. This account of revaluation surplus is only in Ipsas 17 using this model. Now, what happened? The gain from revaluation is called revaluation gain. Okay? Gain from revaluation is what? Called what? Revaluation gain. And it is transferred where? To revaluation surplus. So, if we are using fair value model, you don't have revaluation surplus. Now, what is a gain from fair value? Now, see it here. Number 5. The gain from fair value is what? It's called what? Fair value gain. It's called fair value gain. And it is transferred. Now, this is how it works. We don't have revaluation surplus. Now, where do we transfer the fair value gain? Where? Now, that's why I say you have to understand it clearly and put the demarcation. It is transferred to where? To the surplus or deficit account. Now, the surplus or deficit account is within the framework of statement of performance. That is very important. But remember, Elizabeth, when there is gain in revaluation, you can't transfer such gain to surplus or deficit. That is accounting one code. So you can't see a component of gain in revaluation through the statement of financial performance. Never on the earth. So this gain is presented in the statement of net asset. Now, the last difference, but not important. The last difference, but not important, is number 6. When using revaluation model, a PPE is depreciated. So there is depreciation. There is a what? Depreciation. If you have elected to use the fair value model in Ipsas 16, there is no depreciation. That is a very serious issue. No what? Depreciation. So, no depreciation. Item number 6. Here, no what? Depreciation. Now, what do you see now? It is very simple when discussing as a topic, but very interested when it comes to profession. So if you want to keep your asset not changing, if you want to keep the building not changing, use what? Fair value model in Ipsas 16. Because you can't depreciate it. Do you see how it works? Now, Do you see something in your head? So, when I say PPE, do you see how things are happening? All these issues are very technical. Now, let me now move. Because I can see you are listening very quietly. And today I'm happy to see that all people are here. So I will now add more materials to handle it. So these are what we call accounting policy. So accounting policy in Ipsas 17, now you see the valuation model and what? Cost model. Accounting policy in Ipsas 16, there is cost model and the fair value model. Do you see? Now, let me add another and technical. What are the accounting estimates in Ipsas 17? So, can you see some accounting estimate? Number one, it explains about the method of depreciation. So, method of what? Depreciation is acquitted with Ipsas number 3. It explains that a public sector must elect the method of what? Depreciation. Number 3, it explains that PPE should get impaired. The impairment of PPE. That is in line with Ipsas 21 together with Ipsas 26. Meaning that this standard insists if you own PPE, you must perform impairment. If you own PPE, you must select the method of depreciation. Now, it moves further that once you have selected the method of depreciation, including estimating the useful life, you must revise those useful life annually. Division of what? Useful life or method of depreciation, so that the asset reflects the actual performance of an asset. It insists that initially, when you buy an asset and select useful life, such estimate of useful life is subjected to many errors because this asset may keep on changing in its performance, environment, and others. So, as you select in year 1, after 12 months, you must revise if it is okay or not. So, as you see now, in Ipsas 17, it also insists in order to have a fair presentation of financial statements, you have to adhere to revision of what? Useful life. You must adhere to a revision of rate of depreciation. You must adhere on observing the impairment of this asset in any cases by looking the indicators that may perform the impairment of asset. Do you see how it works? So in this ground, if you have not revised the asset so far, and you keep on using them, number 1, you are conflicting with Ipsas number 3 and Ipsas number 17. You can end up having a fully depreciated asset in your books of account simply because your asset can be fully depreciated when still in use, which is more dangerous because you didn't add validity to this estimate in other cases. Am I clear? Now, in this ground, I will add another key issues. The elected method of depreciation in Ipsas 17, the elected methods of depreciation in Ipsas 17 are the follows. Elected method of depreciation. Method of depreciation. There are three methods of depreciation to be examined in this paper. Number one, straight line method. Straight line method of depreciation. Number two, reducing balance method. Number three, unit of output, unit of output method. So you can see it's very important for you to note. These three methods are the notable methods, and we are going to read them and expect this method to arise in the exam. And you must have some examples in each case. What I understand, the first method and second method is notably known. But the unit method is a problem to some people, and people might have been started sleeping here, and this is the problem. Unit method. Do you understand? Okay, so I have now how to go, because I've told you a lot of things which is almost material to this discussion, but pending the remaining time here, a very important key issue is this method here, unit method, which also we are going to use it when evaluating the impairment. But I want to talk a very key issue for these remaining minutes only on how do we carry revaluation surplus account. In most cases, there are almost 4 papers with diploma and Ipsas being asked on how to go for revaluation model. So I will pick some examples or discuss what is revaluation model in Ipsas 17 so that you can be acquainted with many of these problems. Now, revaluation model. Revaluation model. Revaluation. Actually, in the revaluation model, what is happening and what are the key issues? First step, we must have some facts which arises in the revaluation. Now, what is revaluation? Revaluation is a difference between a carrying amount. I repeat, revaluation is a difference between a carrying amount of PPE and the revalued amount, revalued figure from an expert at the date of revaluation. This is revaluation. So the difference. So this revaluation can be revaluation loss or revaluation gain. So revaluation can result into gain or loss. So in this ground, please take care. What I'm saying is dangerous. For example, if you had a PP being estimated using 5 years, for example. Therefore, initially, you had year naught. You see. Subsequently, you had year 1. And then you had year 2. And then you had year 3. Then had what? Year 4. And last, year 5. Now, if it happens that you have elected a revaluation model, you see, every after 3 years, what does this mean? So, if you have a cost year, isn't it? After 3 years, you must invite an expert recognized by what? A government. After year 3, you put arrows here. Wait, but to make you understand. You put arrow diagram that in year 3, I have to employ an expert recognized by government. So this expert will be employed to perform what? Revaluation. After performing revaluation, the expert must move to the chief valuer of the government and approve such evaluation. Do you understand? It is very expensive to approve these evaluations because it depends on the figure and amount and the nature of the asset. So the valuer will come up with a revalued amount, which has been approved by chief valuer. So this is revalued amount. Here. So this revalued amount in year 3 is picked from an expert. So you call an accountant to depreciate such asset from year 0 to year 3 and to get a carrying amount. So there are two figures here. There is the valued amount and what? Carrying amount. If it happen that the revalued amount exceed a carrying amount, that is revaluation gain. If it happen that the opposite, that is revaluation loss. So this is how it works. So you have to pay the valuer to approve the valuation report. And you have to engage the accountant to depreciate the asset from the date of acquisition to where? The date of revaluation. And deduct all the accumulated depreciation so that you make a comparison. Do you see? Do you understand? Now let's pick another. That is first step and very important. The second step is what I want you to understand. Now, revaluation, as I said now, can be either gain or loss. That is very important. Now, what I should do here, listen carefully here. Let me say revaluation. Let's say here, right here, first revaluation. Yani when you revalue an asset at a first time, you see it. That one can either be a gain or loss. Now see it here. I would like you to stop writing here because it's dangerous. I repeat, if you have first evaluation and it may result into what? Gain or loss, depending on the difference between the carrying amount and the revalued amount from the valuer. Now, when it is a gain, this gain is called the first gain. This is first gain here. Right here, first gain. First gain. What? When it's loss, it's called what? First loss. Now, that's where there is a problem here. If you get the first gain, the standard direct that such gain must be transferred to the revaluation surplus account. If it is a first gain, then what I say? First open the revaluation surplus account. Step number 1. And then transfer the first gain. Transfer the first gain. Now, for those people who are using the so-called kibubu, you see, if you in extra profit, it is a place when you can buy the so-called kibubu to put in money. If you get loss, can you buy the kibubu? No. So, you get the first loss. Don't open. Remember here, don't open. Revaluation surplus. That is very important. I repeat and insist. If you perform revaluation in a first revaluation stage and you get what? First loss, don't open revaluation surplus. Don't. Because you can't open the so-called kibubu. If you're getting loss, you could keep on, you see, waiting for the gain. Now, where do we place the first loss in financial statement? The standard directs that if you get the first loss, if you get the what? The first loss, temporarily, I repeat, temporarily, transfer it. I repeat, temporarily, transfer it to the statement of surplus or deficit. So, temporarily, transfer the loss. Now, this loss is called the first loss. First, temporarily, transfer the first loss to the surplus or deficit account, or Statement of performance. So these words in rates are very important for you to capture some key issues in Ipsas 17. Sophia, you understand? So I repeat, we can have first loss or first gain. If it is a first loss, temporary transfer where? Okay. Any question from there? Now, why the word temporary? That is very important. The word temporary is very important. Now, let's go to the second revaluation, isn't it? Now, as you see, the first revaluation, now let's go to the second revaluation. So I write here, second revaluation. The second revaluation, it can also result into either gain or loss, isn't it? So I would write here second gain and then second loss. So we have second gain and here second loss. Do you see? Now, how do we account for the second gain and second loss? Do you see? Now, let me treat each other separately. All right? Let us see. Second gain. How do we treat the second gain? How do we treat the second gain? Now, treatment of second gain depends on what happened from the first gain. Do you see? Please take it carefully. Treatment of second gain depends on what happened from where? First gain. Now, if, yeah, manake condition, isn't it? If the first gain, if first revaluation was gain. For example, if here I have first gain, isn't it? And now we have second gain. What is happening? You add the first gain and the second gain. You go there on the same positive, isn't it? So here, add. Does add. We add because, meaning the first gain was transferred to revaluation surplus. And the second gain is also being transferred to revaluation surplus. Sasa kwa mfano wewe umefungua kibubu ukapiga boom wakati fine account. Milioni 10 zimeingia, unazipeleka kwenye nini? Kwenye kibubu. Si ndio? Imekuja trip ya kuzunguka kwenda Dar es Salaam. Ukapata milioni ngapi? Milioni 5. Umezipiga. Unaziingiza kwenye nini? Kwenye kibubu. Manake you add. Wanasema awamu 2 umefanyaje? Umeupiga mwingi. Sasa ikitokea kwamba if you have second gain and the first was not gain, it was loss. So we have first loss here. If first you have loss, but second you have what? Gain. In this area, the standard suggests reversing. Sema reversing. Maneno ni ya kitaalamu. nimeyafundisha ili mjue. Tutayakuta akisema reversing manake nini? Kwamba ulikwenda Morogoro kufanya biashara, ukapata hasara. Ukaenda temporary ukairipoti kwenye performance temporary. Labda hasara ya milioni 6. Si ndio? Imekuja safari nyingine, baada ya kupata hasara ukapata nini? Ukapata gain. Kwa anasema hii gain iende kwanza kule ikaliverse loss ya mwanzo. Manake inaenda kufuta ile loss to the amount. Kwa hivyo kama ulipata loss ya milioni 6, saizi umepata gain ya milioni 8. Manake milioni 6 itakwenda kuliverse loss ya kule, utaifuta. Baada ya kufuta ndio sasa utarekodi gain upya kwenye revaluation surplus. That is reversing. Kwa hiyo kuna reversing na originating. Sasa let's see here. Akisema reversing manake ni hii hapa. Originating ni hii hapa. Kwamba kwenye kesi ya kwanza, si ndio? This is a first revaluation and there is a gain. Therefore you originate by opening the revaluation surplus. Do you see? The term originating meaning originally you have a gain. Therefore you put it originally in the reserve. Reversing, what you put into reserve, you have to reverse. Imekasa mpaka? Twende kwenye fact ya pili ambayo itakuja hapa. Hii ni second gain, si ndio? Ni second gain. Tunaona discuss hapa. Let's see second loss. Na yenyewe itakuja fact hizo. Kwamba kama ulikuwa na gain mwanzo, saizi unapata loss, una reverse. Lakini kama una loss mwanzo, tena unapata loss, maana yake inaendelea kwa kuwezi ku transfer. Ndio vitu ambavyo vinatajwa hapa. So let's see the second loss. Second loss. Manake loss ya mara pili itadependi kwanza originally ulikuwa na nini, si ndio? Kwa hiyo kama una second loss, originally ulikuwa na gain 1, si ndio? Manake hapa ina reverse. Lakini sasa kama una loss number 2 and also una loss number 1, hapo huwezi kureverse. Kwa hapo unasema reversing. Ya hapa manake hii gain 1 na loss 2 una reverse. Kwa hiyo these are the concept with this kind of revaluation surplus. Sijui kuna swali hapo nilichoongelea hapo. Sasa hapa sijatoa swali practically. Lakini likija swali hapa utaona kuna mahali pana kuambia hii sasa hivi naenda kule kwa sababu ya hii concept. Ibikasa. Sasa njoo tufanye mfano. I want to give you a baby example so that you understand what am I saying so far. I will put 4 examples separately so that you understand from this evaluation and you will be happy on it. I'm sure nobody can now disturb you from these examples. For example, number 1. Talula, a public sector, acquires a building at cost. So you write of ZS, this one, with the useful life 5 years. Just number 1. After 3 years, the expert revalued upward the building by ZS 60 million. Required discuss the accounting treatment. So, accounting treatment in Ipsas 17. So, accounting treatment. Discuss the accounting treatment. So, you buy a house for this amount of money, and using 5 is how many? 5 years, assuming 0 residual value. But in year 3, an expert has revalued upward, they say, the asset by how many? 60 million. Now, discuss accounting treatment. Do you understand from there? So now, I want to make it very easy here. Solution. First of all, you have 2 lines here. Draw 2 lines. An accountant will keep on reporting the asset using normal accounting policy, isn't it? So, you have here note. The asset is how many? About year 1. What this one? 200. How about year 2? Yes? 150. How about year 3? 100 million. But now it is a time of revaluation. You call for an expert to come. So an expert is now here. You ask him to provide a new value, irrespective of what's happening in accounting procedure. So in year 5, you pick evaluation report. Now what he's saying, he said that the expert has revalued the asset upward by how many? Now what is the evaluation report? 160. Valuation report is 160. You should be very much aware. I can give you the valuation report or give you a valuation surplus. So the difference here is 60 million. Now my question is, what is the accounting treatment? Do you get the point? What is the accounting treatment? I want you to show me the journal entry. Now, this is a building, isn't it? So first of all, I have to put a building account. Building account. What was the cost? Cost 250 million, isn't it? Okay. Now listen carefully, it's very dangerous here. In this account, we have debit and credit. What is a current depreciation? Eh? What is a current depreciation? It's a problem. What is a current depreciation? 50. So you write here, current depreciation 50. What is accumulated depreciation? 100. Do you see? Do you get me? Now you open the account called accumulated depreciation account. Accumulated depreciation account. So this one had its opening, and you have current depreciation, and you have closing. So in this ground, this is what happened. Journal entries are very important. Current depreciation 50 million. You see. Opening, it was 100. Closing, 150. So 150, 150. At this ground, this is going to statement of performance because it is a current depreciation. So I will open somewhere a statement of performance, isn't it? Do you get a point? In this statement, I have to go in a place of expenses, operating expense. It must here current depreciation, which is 50 million, isn't it? But yet, we have not explained something on what? Revaluation. This is a first gain, isn't it? Now, since it is a first gain, then we have to open the valuation surplus. Do you see? So you open the what? The valuation surplus account. And the open building. There is a first gain of how many? 60 million. Do you see? Therefore, this is an account which is reported in the statement of net asset stock equity. This gain will move to PP. That gain. How much is this? 50. Can we all close? What? Oh, sorry, 60. Gain is 60, sorry. Now you can close your books of account. To compute the carrying amount of this asset. Do you remember it was 160, isn't it? Now it's a self-balancing account. Now can you sum the journal entry? What's the figure here? 0. What? 310. 310. So in the balance sheet, you have these figures here. But in the statement of performance, there is no figure relating to revaluation gain. Why? Because we don't advise it. All gain in revaluation surplus are not supposed to be written in the statement of performance. Am I clear? Let's go to the second example. Do you see how I put the journal entries? Assume now this is not a gain, it is a loss. Do you see? Now let's see to example number 2. Example number 2. ABC public sector acquired a building at the S 300 million is a useful life of 5 years. You see. 2. In the year 2, the expert revalued down the building by how much? ZS 70 million. So the revaluation, the first evaluation has gone down. You see, required what? The journal entry. Required the journal entry. Represent, discuss the journal entry. Discuss the journal entry. So it's simple, isn't it? So remember, solution here. Actually, I'll give you this document for you to refer. But first, I want you to understand. Now we have a building. And we have accumulated depreciation. So we have debit and credit. Debit and what? And credit. What's happening? Opening balance of a building is known. What was that? 300 million. And it has been depreciated. What was the current depreciation? Currently, so 300 million divided by 5, 60 million. Now it is near 2. Therefore, accumulated is what? 60. So opening here is 60. Current depreciation to performance is also 60. And the closing balance. So closing balance 120. Isn't it? But now, the revaluation has resulted into what? Loss. So, we don't open the revaluation surplus. Opening it is a mistake. Now, what we are doing here is to open the statement of what? Performance. So, you write statement of what? Performance as its account. And from here, you temporarily report the gain, the loss. So, expense temporary, report the loss of how many? It was 60 or 50, 70. 70. So these expenses will be here temporary. So don't open the valuation surplus. So in this ground, you write performance here. You put what? 70. So performance temporary. Now balance the figure. How much is that? Yes, tell me. So balancing is here. And how much is that? So 110. So this is how you do it. Do you understand? Do you understand me? Okay. Let's go to the let's go to the third example, and very important for you to understand. The third example appears in the previous past papers. That's why I want you to understand. The third example is now explaining the subsequent devaluation when there is first devaluation. Okay. Example number 3. PSSF is a public sector in Tanzania which has adopted Ipsas and Revaluation model in Ipsas 17. The directors of finance Director of Finance has noted 2 evaluation report in the financial statement as follows. Number 1. The first valuation, an expert revalued down a Class A PPE by TZS $80 million. Number 2. The second revaluation, which was done after 3 years, the expert revalued assets in Class A by TZS $120 million. Do you see now how things are coming here? Briefly, discuss the accounting treatment of the above. Discuss the accounting treatment of the above issue as Ipsas 17. Now this is practical, and this is 15 marks. It was 15 marks. So we were given 2 revaluation reports and required to explain the accounting treatment in respect to Ipsas requirement. Now, who can tell me here? Yes, sir. The second evaluation, down. The first evaluation, an expert revalued down. The first evaluation, an asset, okay, this one. Second, okay, upward, sorry. Revalued the asset, the expert revalued upward. An asset can say up by here, upward. Sorry, it is upward. Sorry. It is upward by ZS. Okay. 120 million. Yes, now we have two evaluation moving opposite. We have two evaluation moving opposite, isn't it? So the first issue here is to use professional standards to describe the way it works. Now, let us see. What happened to first evaluation? It is loss, isn't it? Therefore, what we're going to do here, you just explain as follows. And an examiner will be interested to see if you understand the concept. No need of quoting the paragraph, but we need to quote the concept. So we are saying, first evaluation. So you write, the expert has revalued class A asset downward, resulting into a loss. In where? Evaluation amounting what? 80 million. Isn't it? So you stay there. The second line you say, since this is a first loss, since this is a first loss, then we cannot open what? Revaluation surplus account. Thus, the first loss will be temporary. Thus, the first loss will be temporary, recognized in where? Statement of financial performance as follows. So you put the journal entries. So journal entry, you debit, you credit. You debit what? Statement of performance. You credit P by how many? 80 million. So in a T account, you draw a PP account and you had a performance. You see. So PP, you write performance by 80. You credit. Performance, you debit it by what? So say gain. Sorry, this is loss. Say loss by how many? 80 million. That's all. So the examiner will concentrate on this journal entry. Am I clear? Now moving to second evaluation. Depend on the first evaluation, isn't it? So you write second evaluation. Second evaluation. Sasa hapa unasema depend on the first evaluation. So since there is gain, so unasema there is gain of ZS 120 million in where? Second evaluation. So what I'm saying, the accounting treatment of the second evaluation depend on what happened from the first evaluation. So since we have a loss of 8, isn't it? And we have now a gain of 120. In order to accommodate these two, you must first reverse the temporary recognized loss in the statement of performance. So what I'm showing here is this one here. I want to make you understand these cases. So there are two accounts. Number one is the statement of performance, isn't it? Which is now prevailing. Statement of performance. In this statement, there is an operating expense where a loss of how many? 80 was reported, isn't it? Now, we have a gain today. What to do? First of all, we should go to two accounts. The first account is PP, isn't it? So first account is PP. First account is PP, where we want to report the gain, isn't it? But the second account, we want to go here. You open evaluation, surplus. Now, a total gain in PP is how much? 120. So, PP gain here is 120. Isn't it? The first gain must go to reverse this one here. So, this one here. So, gain, say PP transfer. So, it reverses this one here. So, it cancels out. So, income, there is reversing the 8 from previous financial statements. So, this one and this one does cancel because the 8 million was temporary. So you have to reclassify it. Okay? Now, from 120, how much remain? 40. This one is now here. So, gain 40. So, from 120, two pieces, the 80 and 40. So, technically, somebody can tell you, please present the journal entry. You can start. Yeah, that is how it works. So, how do you put the journal entry here? So, there is a performance somewhere by 80. Again, PP somewhere, revaluation. So there are two accounts here. Debit and then credit. You debit PP by how many? 120 million, isn't it? You credit performance by how many? 8. And you credit revaluation surplus. By 40. This is an accounting intelligence. As you put it here, it's possibly you can encourage, you can attract the marker to give you the bonus. Do you see how it works? So, this is what's happening in Ipsas exam. So, if you are sleeping, you can see some of the cases which are not here may be coming to the exam. Remember, this is a final touch. So, do you have any concept? Do you understand anything here? Yes. So, I can reverse this journal entry. For example, first revaluation can also be gain. The second can also be loss. Remember the concept. Do you have any problem? Any problem? After saying that, thank you for listening.